Hello, everyone. We're going to get started with the webinar in just a minute here. Okay. I wanted to welcome all the participants to A Risky Proposition, a webinar about crop insurance and climate change, produced and hosted by the Institute for Agriculture and Trade Policy, or IATP. I am Jim Kleinschmit, Director of IATP's Rural Communities Program, a co-author of IATP's report on this subject, and the moderator for this webinar. IATP just celebrated its 25th year of working locally and globally at the intersection of policy and practice to ensure fair and sustainable food, farm, and trade systems. Today's discussion brings together some key areas of interest and investigation for IATP. What issues does a changing climate and erratic weather patterns, such as we have seen over this last year especially, raise for rural communities and farmers in particular? How are our agricultural research and technical assistance programs helping farmers and ranchers prepare for the new challenges associated with the changing climate? What types of publicly supported risk mitigation are most appropriate for farmers, consumers, and the environment today and into the future? And in particular, when looking to a new farm bill in 2012, will proposed crop insurance scenarios actually address both farmers and the public's risk mitigation needs? We are pleased today to have a group of expert speakers here that are able to dig further into this complicated yet critical topic and set of questions. In addition, we know that many of you on the webinar are also experts in this area, and we look forward to your contributions as well. After the presentations, we will ask our speakers as many questions from the audience as time allows. Due to the large number of participants, we are asking that you please submit your questions using the question panel on your screen anytime during or after the presentations. You can do that by typing them into the box that says enter question for staff and then hitting send. And you can see kind of an illustration of that on your screen as well. So let's get started. Our speakers today are Bill Hohenstein, Scott Marlow, and Julia Olmstead. I will introduce each before they present. Our first speaker is Julia. Julia Olmstead is a senior associate in the Institute for Agriculture and Trade Policy's Rural Communities Program. She works on domestic biofuel policy, climate change, and Mississippi River navigation policy, among other things. For the last decade, Julia has worked on issues related to agriculture and biofuels as a researcher and a journalist. She serves on the Organizational Council of the National Sustainable Agriculture Coalition, was formerly a graduate fellow with the Land Institute in Salina, Kansas. She holds a MS in plant breeding and sustainable agriculture from Iowa State University, an MJ in journalism from the University of California, Berkeley, and a BA in botany and Spanish from the University of Wisconsin-Madison. Julia hails from St. Paul, Minnesota. Julia, take it away.
Thanks, Jim. Well, as Jim said, we put out a paper on climate change and crop insurance in November, right around the time when the so-called secret farm bill was being prepared for the so-called super committee. And back then, as right now, all signs really pointed to a big expansion of the federal crop insurance program, along with a scaling back of commodity subsidies. And in a way, that made sense because, as I'm going to talk about in just a moment, farming is getting riskier than ever. And we're not the only ones to acknowledge that. If you look at the statements that have been made by many proponents of crop insurance expansion, they say precisely that we're in an era of increased risk and that farmers need a strong safety net. But what shocked us was that no one was talking about why farming is getting so much riskier, specifically about climate change. And I know that the words climate change are a political hot potato, but no one was either talking about the need for farmers to take steps to make their farming systems more resilient to extreme weather. And I think that that's really the purpose of our webinar today. So I hope to lay out for you some of the reasons why we should be thinking about climate change in the context of crop insurance and what we might want to do to address that. And then Bill Hohenstein is going to speak some more specifically about the work the USDA is doing to address climate change, and Scott Marlow will get into some of the details around what is and isn't working in our federal crop insurance program. I've made the assumption that if you tuned into this webinar, you accept the basic premise that climate change is real. And I might be wrong in that assumption, and if so, it's going to be a pretty difficult talk, but I hope that's not the case. farmers, as you all know, are already starting to feel the effects of climate change, and a lot of that impact is coming from extreme weather events. Take 2011. According to NOAA, there were 14 weather and climate-related disasters that caused at least $1 billion in economic impact. Last summer was the second warmest on record for the lower 48. Texas was drier last year than any Dust Bowl year. It was its driest year on record. And across the northern United States, 10 states had their wettest years ever, which caused historic flooding along several major rivers. You can see on this NOAA map where many of those records were concentrated. Of course, in any given year, regardless of climate change, we can get lots of anomalous weather. But the data show that extreme weather events like those we saw last year are increasing in frequency. And if you look at this chart, it shows the incidence of billion-dollar-plus weather events over the last 2 decades. And as you can see, that trend line is increasing. Farmers, of course, as I said, are among those who suffer the most from extreme weather. And as you know, farmers experienced record crop losses in 2011. Indemnity payments have so far totaled nearly $9.7 billion, and that's a number that's still rising as the claims process is completed. And in this map from the RMA, you can see where those indemnity payouts were concentrated. Most of them went for relief from droughts in the Plain States, from flooding along the Mississippi and Missouri rivers, and from freezes in the South. Now, given the documented increases in extreme weather and the crop losses that they've caused, it's not surprising to see how much the U.S. crop insurance program has expanded over the last 2 decades. If you take a look at this graph, it shows indemnity payouts since 1995. And that trend line is pretty similar to the one we saw for weather extremes. But, of course, crop loss isn't the only thing that influences indemnity payouts. They also go up when the number of acres enrolled increase, which they have over that same time. As you can see in this chart, but they haven't increased in an equal amount. Crop prices have also gone up, and that means an increase in outlays as well, as it costs more to reimburse an expensive crop. But weather has clearly played a very large role in increasing our federal expenditures on crop insurance. Now, I think most people would agree with me that crop insurance is a very good and very necessary thing. And as I've just said, farming is becoming riskier all the time. And because of that, farmers need more protection than ever. And as a society, I think we've decided that protecting farmers is important, and that's why we're willing to spend billions of taxpayer dollars on crop insurance. But part of the reason why we're spending that money, I think, is to also try to build some security into our food system, because eaters are also at risk from climate change. But unfortunately, our current crop insurance system doesn't help keep our food system more secure. In fact, I'd argue it maybe does the opposite. The federal crop insurance program offers farmers several kinds of policies to protect from losses that are caused by either natural disasters or low prices. And farmers can choose levels of coverage that range from 50 to 85%. That level might go up in the next farm bill as many groups are pushing for an expansion of coverage. They can pick policies that protect against either yield or revenue losses, or a combination of those two. And federal subsidies right now pay for at least about 60% of policy premiums, and that depends on the kind of policy that you choose. And most farmers enroll in these programs as long as they're eligible. In 2009, more than 80% of corn, soybean, wheat, cotton, and peanut farmers participated in some form of federal crop insurance program. And as it turns out, more than 3/4 of the total liability that's covered by the federal crop insurance program is represented by only 4 crops. In other words, most of what's covered by crop insurance is monoculture. And you can see that represented in this chart, that really corn, soybeans, and wheat are the main crops that are insured. And that, I think, should raise some alarm bells in your heads. Because when extreme weather hits, the farms that do best are generally not those monoculture farms. They're diversified, oftentimes smaller to mid-scale operations that have a mixture of livestock and crops, or maybe several kinds of cash crops. And frequently, they also find ways to incorporate perennials into their mix. Recent research backs up this claim that the key to resiliency on the farm is diversification. And there are a few ways that diversification can help farmers. A simple way is that diverse agricultural systems provide a buffer to extreme weather or other climate effects by helping farmers simply to hedge their bets. In an integrated crop and livestock system, for example, the row crop can fail and the farmer can still produce the animals. But diverse systems are also physical buffers. And in this March 2011 paper in Bioscience by Brenda Lynn, she listed some of the primary benefits to agriculture from diversification as these: pest outbreak suppression, decreased pathogen transmission, increased production stability, and increased drought or wet weather protection. Diversification is a real hallmark of sustainable agriculture, and many of the practices that are associated with sustainable systems, like the use of cover crops, crop rotations, organic practices, can increase soil quality and soil organic matter and can reduce the need for synthetic input. And those practices really lessen a farmer's financial risk. The less that you have to buy in terms of fertilizer or synthetic pesticides, the better off you are, especially when the cost of those things climb. And it's no small matter also that these practices have the potential to increase soil carbon sequestration and to reduce direct greenhouse gas emissions, because I think mitigation should be our primary mechanism of climate change adaptation. But unfortunately, on-farm diversity and sustainable practices are discouraged by our current crop insurance program. Integrated crop and livestock systems and other more complex farm systems have a harder time getting insurance than single crop farms. Organic producers pay a penalty and are reimbursed at conventional rates rather than at the typically higher organic rates, and fewer federal options exist for fruit and vegetable growers. Now, for those of you listening who might disagree that small to mid-scale diverse farming systems are our best bet for climate resilience, I'd hope you'd at least agree with me that a secure food supply will require, at a minimum, maintaining topsoil, adequate water supplies, and reasonable expectations of which crops will grow where. But our federal crop insurance program fails there as well. There are currently no conservation requirements for subsidized crop insurance. Participation in conservation compliance, which is a very minimal set of standards to reduce soil loss on highly erodible land, is a requirement to receive the major commodity subsidies. But that's not so for crop insurance. And it's widely anticipated, as I said before, that direct payment subsidies will disappear in the next Farm Bill and be supplanted by this expanded crop insurance system. And I'm afraid that that will leave a gaping hole for soil protection. Now, I'll say again that I think that the billions of dollars we commit annually to the federal crop insurance program is a pretty good indication that we value a secure food supply. So if in the face of climate change we decide to continue to base our farm support system primarily on risk management products and to offer publicly subsidized financial risk mitigation to farmers, it's only logical, I think, and fair that we ask them to take steps to reduce risk on the ground. And for that reason, IATP proposes that in the next Farm Bill, eligibility for federally subsidized crop insurance policies be linked to what we're calling climate compliance. Climate compliance could take a lot of forms, but in the way that we've conceived it, it would be a requirement that farmers develop and follow a USDA-approved, NRCS-administered climate adaptation and mitigation plan that's adapted to local conditions. In drought-prone regions, this might mean choosing drought-tolerant crop varieties or changing grazing or irrigation management. In flood-prone areas, it might mean incorporating perennial crops, using cover crops or buffer strips. Because climate change won't affect every farm in the same way, each farm will, of course, need its own solutions. Now, after a farmer were to create a climate compliance plan, they could receive support from Farm Bill conservation programs like the Environmental Quality Incentives Program or the Conservation Stewardship Program to help offset the cost to the farmer of these transitions. And I realize that in our current state of budget austerity, it might seem kind of radical to propose additional Farm Bill expenditures. But I think that this is actually a cost savings measure. First of all, the increased budget for conservation programs and compliant provisions that would be required if we were to do this would be at least partially offset by a reduction in indemnity payouts. We would be losing fewer crops because we would have those protections on the ground, and therefore we would be paying out less for crop losses. But what I think is even more important is that this program would avoid the most risky proposition for farmers and U.S. taxpayers, which is a bottomless crop insurance program that refuses to address climate adaptation. If we don't put provisions like this in place, we're going to put ourselves in a very frightening place. There'll be no limits on outlays for crop insurance, which there aren't right now, and no protection for no protection on the ground to prevent those crop losses. That's the bulk of my presentation, and so I look forward to your questions. And I just want to say that I hope that this webinar is the beginning of a discussion about how best to protect farmers and our food supply. And I'll hand it back to Jim.
Great, thank you, Julia. Very good introduction to the whole topic overall. And I would also remind folks, if you haven't yet, it is worth reading the paper that Julia is referring to. It covers in a little more detail some of the stuff she was talking about. And I also want to remind all the participants that if you do have any questions, now's the time to send them in. While you're thinking of them, we will address them at the very end. With that, we're going to move on to the next speaker, Bill Hohenstein. Bill serves as Director of the Climate Change Program Office, CCPO, and is responsible for coordinating climate change research and program activities for the department. The Climate Change Program Office provides coordination and policy development support for the department, the USDA, when I say department I should say, for the USDA's climate change program. It serves as a focal point for support to the Secretary of Agriculture on the causes and consequences of climate change, as well as strategies for addressing climate change. Before arriving at USDA, Bill served as the Division Director in EPA's National Center for Environmental Economics. Bill has a BS in Natural Resource Management from Cook College, Rutgers University, and an MEM in Resource Economics from Duke University School of Forestry and Environmental Studies. Welcome, Bill. Are we ready? Are you ready, Bill?
Hello?
Yep.
Great. Hi. Sure. As Jim mentioned, my name is Bill Hohenstein. I'm the Director of USDA's Climate Change Program Office. We're a small office within the Office of the Chief Economist, and our role is quite simply to integrate climate change into the planning and operation of the department. And I've been with the department now for just over a decade. And as I describe to people, it's a work in progress. But we are making great progress. For example, the 2010 strategic plan for USDA for the first time mentions climate change. And in fact, it includes two specific goals focused on integrating climate change adaptation into our planning and operations and to promote activities to mitigate greenhouse gas emissions and increase carbon sequestration in agriculture. And so we're moving rapidly to assess climate change in our programs and operations and how it affects our mission, and to move from research into operation. And that includes an increased and expanded role for our mission, for our program agencies like the Risk Management Agency, but also APHIS, the Natural Resource Conservation Service, the Farm Services Agency, and the Forest Service and Extension. And so we're quite busy within the department. What I wanted to talk a little bit with you about today is some of the activities within RMA to assess the implications of climate change. And in 2010, they put out an initial study looking at climate change in agriculture and the implications or the potential implications for crop insurance. And so I'll go over that quickly and then hopefully leave some time for questions. The place to start is, what do we expect from climate change? And there are a variety of scenarios, much of which we draw from the IPCC. And here is sort of a central case, what they call the IPCC A1B scenario. And there are really two concerns that we have that are of significance: temperature changes, and you can see expected temperature changes in the middle of the country, and then also significantly expected changes in precipitation. And here, there's a lot of confidence between the models that the southwestern part of the country will become drier and the northeastern part of the country will become wetter. Where that line is with regard to wetter and drier tends to cut right through the Corn Belt, the most important commodity producing region in the country. And so there's a lot of uncertainty and a lot of disagreement within the models as to whether the Midwest will get wetter or drier or to what extent. And what we've seen so far is that pretty significant portions of the Corn Belt are getting wetter, especially the northern part of the Corn Belt. Before going into the crop insurance analysis, we recently put out an overall assessment of climate change in agriculture and came up with a number of important findings. One is that we're already seeing the effects of climate change in agriculture. As temperature rises, there will be implications of temperature increases, specifically at the points of pollination and grain setting. We found that some of the horticultural crops are liable to be more vulnerable to climate change than some of the cereal crops. And then it's not only the crops that are affected, but weeds and pathogens as well. And so we're not just concerned about the implications directly on the crops, but on the systems that they reside in. So to describe the crop insurance program, it's run through the FCIC, the Federal Crop Insurance Corporation, and managed by RMA. The FCIC develops and approves insurance policies. And provides, as Julia mentioned, operating subsidies to the crop insurance companies. Crop insurance, it exists in most counties across the country, but a lot of the policies are centered in the Midwest and the Corn Belt, and in parts of Florida and California as well. The losses that occur through the crop insurance program are mixed, many of which are related to drought, also excess moisture, and we saw that in the Midwest this year, hail, hurricane, and other excessive heat. Heat causes a small amount of the losses overall throughout the country. In 2010, in response in part to a request from Congress and a report by the GAO, the crop insurance program and RMA conducted a study of the implications of crop insurance on the program. The study is available on RMA's website. It's also available through the Climate Change Program Office site as well. They focused on, again, the AB1 scenario of the IPCC and used 3 separate models. The Goddard model, 2 separate runs, a model called the Coupled Global Climate Model, which is the Canadian model, and the MIRI model, which is the Japanese model. And these scenarios actually are pretty wide-ranging. What's interesting about their analysis is that they linked it to a model of affected crop yields and then an economic model to show the economic effects of changes in crop yields. And then finally linked it to their actuarial model to look at changes not only in yield but in the program and revenue distributions. Driving all of this are the changes that are expected from climate change. And the model results really vary, especially for the Midwest, and that had implications for the results. The 2 GFDL models showed pretty significant increases in temperature, and at least one of the scenarios showed, well, actually both showed pretty significant decreases in precipitation. The Canadian model showed similar increases in temperature, not quite as dramatic, and then almost no changes in precipitation, and that was significant, whereas the Japanese model showed low increases in temperature and pretty significant increases in overall precipitation relative to baseline. And that has implications for the effects on commodity production. You can see the black line shows baseline for a particular county in Iowa, whereas the GFDL, both GFDL scenarios show decreases in yields. The MIRI model, the Japanese model, shows an increase in yields, and the Canadian model showed pretty much no change. And that plays out pretty much across the country, where in this slide you can see increases in production in the greens and the blues, decreases in the yellows and the reds. And The MIRI model shows increases for corn pretty much across the eastern part of the United States. The two GFDL scenarios show decreases in much of the eastern United States, although more dramatic in the higher temperature scenarios. And the Canadian model shows a real mix across, in sort of this checkerboard pattern across the eastern United States. The impacts on soybeans were different, driven more by temperature, and in the two GFDL studies where you see increases in summer high temperatures affecting soybeans in the southern range of soybeans, whereas with less temperature increases in the MIRI model, we're showing in these scenarios, at least through 2045, 2050, increases in production pretty much across the eastern United States. And so when you kind of try to analyze that nationally, the effects are pretty modest in aggregate, but that masks the underlying significant regional effects and the regional uncertainties which occur driven largely by precipitation. You know, whether this line for whether the country is wetter or drier is west of the 100th meridian and the western United States, or occurs through the Corn Belt. Where there is consistency, there's decreases in yields in the central and southern part, increases in the north, and parts of the Pacific Northwest. I wouldn't include the Southwest in that. And this is fairly consistent with USDA's climate change assessment and other recent studies. I also would note that we're in the process of updating our national assessment. In 2013, we'll be releasing a new assessment report, and in that report, we'll have a fully integrated analysis of changes in crop yields and the economic effects, and so an update of what was done, I think, initially for this RMA study. When translating this to the effects on the crop insurance program, you find that, you know, again, there's a lot of uncertainty with overall small changes to baseline levels of return, maybe small minus to small increases. But that a larger effect actually on the FCIC. Now, the crop insurance program has some components within it that can be naturally adapting to climate change. The premium rates are based on historic losses, and they can adapt to changes in risk. And I think that's important when you're thinking about how do we incorporate climate change into the program itself. I think the first part of this is assessment. The second part is actually looking at the structure of the program itself and how farmers can adapt to climate change. And first of all, there'll be incentives to basically for farmers to adapt. The premium rates themselves are set based on risk, and RMA is looking at how to integrate more recent changes in risk. And the other thing that is naturally adapting is the coverage itself. And so if yields within a county, say for corn, go from 180 bushels per acre to 140 bushels per acre, the farmer's not going to be able to get the same coverage because the coverage is based on average yield. So as yields decline and as risks go up, the premium rates will increase and the covered crop will decrease. And so because farmers share a substantial portion of the risk, there's an incentive built within the program as risk changes for farmers to change their management to mitigate that risk. I wanted to close with just a few words on sort of where this fits in overall within USDA. As I mentioned, you know, we're trying to integrate climate change into all our planning and operations, and the crop insurance program is simply one, I guess, leg on that stool. We're certainly working with the Natural Resources Conservation Service to integrate climate change into our conservation planning, and that includes looking at areas where we can improve water management. We realize that especially in the early parts of the century, climate change is going to manifest itself in terms of changes in water, whether that be too much water or too little water. And in particular, we're concerned about the Southwest and looking at to integrate improved water management as an important component of our conservation programs. We're also integrating climate change into forest management plans. We're providing guidance to national forest managers to begin to integrate climate change adaptation into management planning as well. And so there's a variety of activities going on across the department focused on climate change. We're moving out of the lab, although we're continuing to focus pretty heavily on research and developing new cultivars of crops that can be more resilient to climate change and better cropping systems that can, again, improve water management and make the overall agricultural systems more resilient to climate change. And with that, why don't I stop and turn things back to Jim.
Thank you, Bill. That was really informative. We're going to move on to our third and final speaker, Scott Marlow. Scott is the Executive Director of the Rural Advancement Foundation International, or RAFI USA, a nonprofit organization based in Pittsburgh, North Carolina. Scott previously directed RAFI's Farm Sustainability Program, providing in-depth financial counseling to farmers in crisis, education on disaster assistance programs and access to credit, and addressing the needs of mid-scale farmers who are increasing the sustainability of their farms by transitioning to higher value specialty markets. Scott's specialty is financial infrastructure, including access to credit and risk management for value-added producers. He has served on the steering committee of the National Task Force to Renew Agriculture of the Middle, the Organizational Council of the National Sustainable Agriculture Coalition, the board of the Southern Sustainable Agriculture Working Group, the board of the North Carolina Farm Transition Network, and currently serves on the research committee of the North Carolina Agricultural Advancement Consortium. He has a master's in crop science from North Carolina State University and a BA in political science from Duke. Welcome, Scott.
Thanks very much. This is a really good conversation. I'm looking forward to having more of the folks who are on this involved in the conversation. So far, what we've been talking about is a lot about how crop insurance will interact with the changes that take place in global climate change and what that means in terms of yields and all those types of things. And what I wanted to spend a little bit of time on was how crop insurance structurally drives production decisions that have a big impact on the resiliency of agriculture and some of the issues that were brought up at the beginning. Let's see, just a second, I'm sorry. So, you know, while we focus on crop insurance as risk management, the effects of crop insurance programs drive investment and production decisions long before there's a disaster, and we've seen this quite a bit over the last few years. Basically, production follows investment and investment safety. So we've had a series of folks who frequently the determining factor on what kind of production system they're allowed to use is their banker. And as we get a better and better safety net for some areas of agriculture, what it does is it creates a deeper and deeper gap and bigger and bigger challenges for those areas which are not covered by that safety net. And I want to reiterate what Julia said at the beginning. That certainly crop insurance is a very important part. It is a very important program, important part of risk management. But we see these gaps getting wider and having broader implications. So I'm going to just contrast two farms. This is John Vollmer's farm. Actually, he got a really great write-up in Southeast Farm Press this morning. This is a farmer that we've worked with quite a bit. There's actually a video of him talking about crop insurance issues on our website. He calls this risk management issue the one great undoing of our plan, this vulnerability. This is a farm that has 30 acres of organic mixed fruit and vegetables. They do quite a few things: irrigation, cover crops, soil building, all kinds of things for soil management. They market through a whole series of a diversity of markets, including direct markets, CSA, farm stand, and wholesale through a series of different stores. They harvest and sell 11 months of the year, and the single event vulnerability, that is, if you had a hurricane come through, which is sort of one of the things that we use here in North Carolina, what is the max of their income that they would lose? And it's about a 20 to 25% single event window. So at any one given time, if they had a hurricane come in, what percentage of their income would be lost? They also have diversity of investment windows. That is the time from when money is invested in a crop until the return comes back. Everything from multi-year for things like blueberries and raspberries to, a very narrow window for some fruits and vegetables. If you contrast that with the James Farm, it's about 800 acres of corn, cotton, and soy with a 2-month harvest. So, for a farm like that, if they get a hurricane in late August, early September, it's probably 90% of their income that's really at risk in that vulnerability. It's about a 6-month investment window. They're, from the point at which they're planting in March and April. It's dry land, so they do not irrigate, but they do use no-till and some other things like that. And it's a commodities market with a single buyer, so they're selling in a single place. So if we look at these and we say, okay, which of these is riskier? If we're talking about risk here, the diverse crops, diverse harvest windows, diverse markets, versus just 3 crops, a single harvest window, and a single market. I think we would agree that that the Vollmer Farm has done a lot more to address these issues of risk. But when we add to that question, which is riskier to the banker, with no effective crop insurance for the Vollmer Farm, disaster programs that only compensate at the wholesale price rather than their much higher organic and direct market price, compared to the other farm where you're getting 75% crop insurance coverage and disaster programs that can take it to 95%. The Vollmer Farm, the highly diversified farm, is seen in the banker world, the investment world, as being too risky. And what we see is that this has huge implications on the ability for farmers to transition into more diverse systems and to implement more production-based risk management strategies. So why is that? Well, in the banking world, insurance and disaster programs are assured income, and that insurance allows the crop to be used as collateral, and this is a very big deal. Without effective crop insurance, which can either be due to the what crop they're producing, it can be due to the production method or the market that they're selling into, they do not have that assured income that a banker is looking for, and they're much more likely to have to use real property as collateral rather than the crop as collateral. These things also reinforce the banker's pattern of familiarity. So the crops that the banker is most likely to be familiar with. We see this all really coming back to data. All insurance is based on actuarial tables that quantify the frequency and severity of risk. If you want to really back of the envelope, if you want to understand how expensive insurance is going to be, you take the value of the crop, the frequency of the disaster, and the severity of the disaster, and multiply them together. So if it's $100,000 and you get a disaster every 5 years, that's 20%, and then it's a 50% loss, that's 10%. So that's a $10,000. That's a $10,000 cost. Commodity programs over time have created extensive yield and price data, which allows us to refine those risk profiles and therefore create cost-effective risk management programs. Without extensive data, emerging markets and products have really poorly quantified risk profiles. And what that means is that basically that it's going to be a lot more expensive. So there's an inherent bias here, which is going to be that crop insurance, the current models, will always select for uniformity and scale, things that are grown on very large scale and grown in monoculture or uniformity. And here's another issue which is very important as we look in this Farm Bill at proposals to increase the levels of coverage in crop insurance, which is insurance or disaster program-based risk mitigation can then reduce the economic benefit of production-based risk management. So, and this goes back to the issue that Julie raised at the beginning, which is crop insurance basically is after the fact and not, it is it provides income after the fact. It's not preventative. So the question is, how are we balancing the need for farmers to invest in preventative risk management, which also addresses the issues of global climate change, versus relying on insurance or disaster programs after the fact? And so what we see is the importance to balance these two types of risk management so that we don't basically price production system-based risk management out of the farmer's options. So what we see is basically three options for being able to drive investment into more the more diversified and greater conservation production systems. One is to begin to quantify risk differently, which is to quantify the production-based risk management. So while we know some things are positive, so we know that increased organic matter in the soil reduces susceptibility to both drought and flood, can we say to a banker, it does it by 4% or 5% or X%? And the other is just a straight proof of concept. Can we demonstrate that the risk mitigation potential for a lot of these practices? The second is to extend risk management programs through the development of new insurance policies. So for instance, in the Vollmer Farm, if you think of it in terms of like a rock climber who's free climbing and puts in a piece of protection that they can climb past, in talking with the Vollmers, what they said is if they're able to get crop insurance on their strawberries, that provides them a significant amount of risk management, which allows them to take risk in other areas of the farm. So developing these new insurance policies is an important place. Opening up these programs to the farmer's price, I want to highlight the fact that RMA over the last year created an organic price election in corn, soy, cotton, and processing tomatoes. That's a very positive step forward, but continuing to address this issue of the farmer's price versus wholesale conventional prices. And then advocacy for individual farmers, and that is this is something that we do quite a bit, which is working with individual farmers to make sure that they're able to make their best case and to get into crop insurance programs. It is a very important place where we test these programs. The other issue is that if we acknowledge the driving of investment, it's the creation of alternative investment and to change the risk tolerance of investment pools, and that's by creating loan pools which have a different risk tolerance, or some of the work that's being done in slow money. All of these have very important effects and very important interaction with this management of risk and diversification and increase of conservation and production. And I'm going to stop there and let me see. Thank you very much. That's our website is rapidusa.org. And like I said, we've got a profile of the Vollmer Farm and some of their issues on our website and other materials about it as well. And I will throw it back to you and look forward to the discussion.
Great. Thank you so much, Scott. And thank you to all of the presenters. I think that was a lot of content to cover in a short time, but I think it really sets us up well for addressing this kind of intersection of all these issues. We've got about 15 minutes left, and we have gotten a number of questions in. I'm going to start by just kind of asking one broad question to all of the participants. I think it's a very basic one. You know, knowing that this is something we're talking about, and obviously, you know, Bill is involved as much in the movement of this kind of an idea of conservation or climate compliance. What are the barriers, or how steep are they in framing crop insurance in this way to both legislators and policymakers? And I think when they say this way, it's both this question of, you know, how you tie it back to climate, but then I think some of the broader questions that Scott raises about how to improve it. And is this approach making any waves on the Hill? Julia, do you want to take a first crack at that?
Sure. Well, there are some pretty big barriers right now, and I think the two main ones that I see are that, first of all, climate change is not really spoken about on the Hill right now, and then secondly, anything that hints at that increased funding, and the need for increased funding is also doesn't get you very far. That said, I think that there is a lot of sensitivity right now to the risks that are being posed by extreme weather. I think everybody realizes that. I think 2011 hit people very viscerally because there was so much devastation, really, up and down the midsection of the United States and Florida and all over the place. So I think there's a real sense that we need to figure out a way to do something about that and to protect our food system. And I think the other sign that might be somewhat positive is that the shallow lost revenue proposals that have been floating around for the next Farm Bill, and these are proposals to expand the crop insurance program to really high leverage levels of coverage, 90–95% coverage levels, did actually in the quote-unquote secret Farm Bill, they did include conservation compliance provisions. And so that to me was a good sign that there is a sense that that we need to try to start to make these links. But I still think that there's some pretty big hurdles because, like I said, it's really hard to talk about climate change. But I think extreme weather is the ticket.
Great. Scott, do you have anything to add to that?
I would say the politics of crop insurance is interesting because we had a whole series of ad hoc disaster programs all for quite a period of time. A lot of the disaster assistance was done through ad hoc programs, and with the creation of the standing disaster programs in the last Farm Bill, what we saw was a push to move out of ad hoc programs and disaster programs at all and into crop insurance. So you have requirements, you have both an increase in the subsidy over time, but also you have requirements of crop insurance or the non-insured disaster assistance program, NAP. You have a prerequisite for participating in one of those programs before you can get disaster assistance. And so Congress has seen this transition into crop insurance as a way to address to get a limitation, to get a handle on the large disaster assistance costs that have been a part of ad hoc disaster programs. The problem is that as they make that transition, what it does is it leaves an increasing amount of agriculture in the dust, because with those requirements, if you don't have cost-effective crop insurance and NAP is not cost-effective, then you're boxed out of all the rest of the disaster programs. So we have to look at crop insurance, not just in and of itself, but in the context of it as seen as a cost-reducing measure to come out of ad hoc and standing disaster programs. So I think that that's an important part of the policy puzzle.
Great, thank you, Scott. Bill, do you have anything to add to that question?
Sure. Yeah, I think that, this is a really interesting discussion. I think some of these points, I think you could take climate change out of the equation and look at the structure of the crop insurance program and more generally sort of like USDA support to farmers and and programs that help address risk. And I think there's some good ideas here. I noticed one of the questions had to do with loss prevention incentives, and you could think about if farmers had best management practices that could help them better manage water. With that, could you somehow incorporate that into risk premiums? I think there are a lot of interesting things out there. The other point that I wanted to make had to do with the assessment itself, and Julia mentioned extreme events. There are a couple of limitations we have to this study, and I think one, I alluded to that there's a lot of disagreement within the models, especially with regard to the Midwest and how the Midwest is going to be affected with regard to precipitation. The other main limitation is that we don't have good projections of changes in the likelihood of extreme events. And when it comes to assessing something like a crop insurance program, to the extent that climate change alters the probability of extreme events, that's going to be pretty important. And so there's still some science gaps, some underlying science gaps in our understanding of climate change that make it difficult for us as we move to integrating and addressing climate change through our operations.
Great, thank you, Bill. And a little bit on that subject, we've gotten a lot of questions about how is your office working with RMA on climate change issues related to crop insurance, and is there any work specifically underway to address the lack of insurance on diversified farms, and would that be viewed by USDA as one solution to addressing some of the climate change risk?
Yeah, I don't know the answer to that specific question about looking at, in the context of climate change, whether RMA is looking at looking at diversification of farms and how that affects risk. I do know that both RMA and APHIS are identifying their major climate questions and working closely with our office to work with the research agencies in the department to get those questions answered. And so, there's, like I mentioned, there's work underway in the Economic Research Service to improve our economic modeling of climate change and agriculture, and a lot of that information will come out in this next national assessment. And so our office works with, I think, 13 or 14 agencies, USDA agencies across the department. We meet monthly. We meet more than that when we need to. And much of our work right now is to try to get the questions answered that the program agencies have, that the agencies with program and mission responsibilities have answered to the best we can.
Great, thank you, Bill. A question for me and for Julia really is has there been a reaction from any of the private crop insurers and their reinsurers in turn to what we're proposing, and are there any incentives being considered to make these proposals commercially attractive in the shorter term, or is that seen to be in making losses sustainable and premium? Kind of addressing that through the premiums. So, Julia, do you want to talk about that?
Sure. I'd also be interested in hearing what Scott has to say around the same question for the things that he's proposing. But as far as climate compliance, we're just starting conversations with private insurers around that and to hear their perspectives as what they see, would be the hang-ups for them. I think a couple points on that. One is that, I think you could make an argument that it's in their best interest. If we have sustained catastrophic losses year after year, that's a pretty tough way, I think, to stay in the insurance business. And the other thing is that I think it's sort of up in the air right now as to who's gonna be running those programs in the future. There have been some proposals to transfer the administration of the crop insurance programs to the FSA and out of the private insurance industry. So a couple things at play there. But yeah, Scott, do you have any thoughts on that?
Yeah, I would throw in, and I know Jeff Shazinski's on this as well. He and I have done a lot of work on the AGR Light, Adjusted Gross Revenue Light program, which is really the first model that tries to address some of these issues of diversity and in production and in crops. What we saw was that one of the places where AGR Light has really fallen down is at the private provider level, which is that because it's, basically all of these things that we're proposing add complexity to the selling of and implementation of crop insurance. And when you add complexity, folks whose job it is to sell it and to make money off of it that can be challenging. And one of the places where we saw the AGR Light really fall down was at that interaction between the farmer and the salesperson, because of the complexity, because of the challenges of doing it. So I'm curious to see how the industry reacts over time, but we do see that at a sort of at the individual delivery level, that the more complex it is, the more difficulty there is in implementing it and having it get sold.
That's great, and I think that gets at one of the broader questions we're getting across, is, from the audience, is this question of, how do we go about making sure that when addressing climate, we're also looking at the other issues around crop insurance, especially that smaller, more diversified farms face. I think Scott laid that out in his presentation pretty well, but I think that's a key question within this, that we see this opportunity around addressing climate risk is also an opportunity to improve the overall delivery system. But one question we've also gotten on this is, how would we respond to folks who may ask or may question this as an infringement, such a USDA approved or required climate adaptation program as an infringement on farmers' rights, or conversely that requiring these will actually put smaller and organic farmers at a disadvantage because of costs or difficulties in doing that, considering those are the very people we're trying to help in this regard and who are so important to sustainability and mitigation. Who would like to take that one on?
I'll take on a first cut at the first one, which is the question about, is this an infringement on the rights of individual farmers? And one of the things that we hear frequently about any kind of limitation of benefits, either in terms of commodities or in terms of crop insurance, there have been proposals floated around payment limitations around crop insurance, those types of things, which is, if a person is going to choose to produce in whatever way that they want to, that's cool by me, as long as we deal with the issue. Well, the question is, just don't ask the federal government, don't ask me as a taxpayer to subsidize it. So when we have about a 50% subsidy of the premium, if this was a private insurance product that the person was paying the full premium on and those types of things, then that's a whole different ball of wax. But in my mind, the fact that we are heavily subsidizing the premium then creates a responsibility to maximize prevention and maximize the mitigation of potential loss, which is the pieces that we're looking at adding in here. I think that's, what happens, what people want to do in private, with private insurance, and there are insurance, you can get private crop insurance that is not federally subsidized. You can insure almost anything these days. But the issue to me here is, if we as a country and we as taxpayers are choosing to put very large amount of money to subsidize the mitigation of risk for farmers, then I think that there is a responsibility to then be able to put limitations on that say, we'll subsidize it, but only if you are complying with these things that help to mitigate risk, that help to have greater public benefit than just you get to not have to worry about a hurricane coming in. So anytime you're talking about a subsidy and public outlay, you then have to look at the public benefits, and that's what we're in essence talking about here, is how do what are the public benefits that we are expecting in return, in essence.
That's right, and I would just add in as the moderator too that I think the point underneath it, though, and I know we all agree with, is critical, that in developing this, we have to be clear, as we do with all these kind of tools, that in the end have to work for such a diverse scale of farmers and farming operations that we don't create something that in the end is a barrier in itself to the smaller diversified farmers who may not have, who may have more issues with some of that kind of planning work. So I think that is still a valid concern in this. With that, we're actually at the hour. I want to let people know that if you didn't catch all of it, or if you have colleagues who'd be interested in this, we are recording it and we will make it available to folks on IATP's website. And I think we can even send that information out to participants afterwards as well. But with that, I just wanted to say a great big thank you to our presenters. I think this is a difficult topic, and a bigger thank you to the participants, because I think it's critical that we discuss this and that we bring together the different capacities we have in addressing something that really links such emerging science issues as how agriculture and climate are linked and how they interact with the kind of broader kind of necessary tools for ensuring a secure food supply and that our farmers can stay on the land. So I think the ideas that are put forward here are just the start of the discussion, and we welcome all of you to kind of figure out with us as we go forward how best to make sure that we are providing the right kind of mechanisms to our farmers and ranchers to address the increasing volatility and changes that we see happening, but in a way that not only ensures their financial risk is met, but also that we actually produce the food fiber and everything else that they produce for us, but that we all depend on. So I think this is the underneath question we have here, and it's just the beginning of the discussion. And we thank you all for joining us in that, and we look forward to continuing that with you. So thanks again to the presenters, and thank you to all the participants.
Thanks.